Thank you, Laurence. We have a great panel here tonight, and I will do very short introductions so we can get into hearing from the group, which represents both the public and private investors who are very active right now in clean tech investing. We have from New York State, Mike Shimazu, right to my left. I'll just run right down, who is from NYSERDA. And one thing that might be helpful is to see a show of hands of people who are with or heading up entrepreneurial ventures. Yahoo!
All in New York City?
Who's in New York City? We love this. Great. Okay, so Mike is going to be talking about NYSERDA, which is an organization funded by the System Benefit Charge, which is what we all pay when we pay our utility bill. And part of that fund is dedicated to research and development of new technology for energy efficiency, and Mike runs those programs for New York State. So that's non-dilutive funding for new ventures in these areas, and he'll talk a lot more about that. Mike is got a background both as an engineer and as an entrepreneur, so he's worked on the corporate side as well as on the government development, commercialization program side. So this is a wonderful opportunity for us to have him here today. He's down from Albany and assures us that he comes down here on a regular basis. So you will see him some more, and NYSERDA has an office in New York City, which they are expanding. I would also like to introduce to you Maria Gotch, who is to Mike's right. Maria is the president and CEO of New York City Investment Fund, and this is a key strategic investor in clean tech, has invested in several clean tech businesses based in New York City, and you will hear more about the criteria for what New York City Investment Fund and what they're looking for in terms of qualifications for entrepreneurial ventures, and then we'll have a conversation about how all these parties play together. The third person who I'd like to introduce you to is Mike Carr, to Maria's right. Mike is here from Washington, D.C. Mike joins us from the U.S. Senate Energy Committee, and Mike has been instrumental in crafting legislation for the financing of emerging technologies. So if you are familiar with the funding, which was really significant in California for Tesla and then Fisker, those manufacturing loan programs are, the legislation for them is what Mike was responsible for writing. He is also involved in the lighting prize for LED bulbs. That's something that's been written up in the Times recently. And the SITA program, the Clean Energy Deployment Administration, which is the longer-term financing platform for clean energy technology deployments. So Mike is going to talk about some of the initiatives and legislation he's working on right now, so we have a little bit of a vision into the future for the next set of votes that the Senate will be making for funding energy, clean tech technology in the near future. So we're very much interested in hearing about those, especially the Valley of Death funding initiative. And he can explain to you some more about that. To Mike's right is Dave Kirkpatrick. We're very fortunate to have him here in Manhattan this fall. Dave is one of the initial people in the country investing in what has become known as impact investing. It used to be known as triple bottom line investing. He has made investments for I don't know what fund you're on now, but many second investments starting in Durham, North Carolina, then opening up an office in New York to fund, among other things, clean tech investments that have community and environmental impacts. So we have a chance to hear about that. And one of the things that I'm very interested in discussing as part of this is how as an entrepreneur you navigate the different parties, how they're working together, and how you can work with one and then work with others and to your advantage. So what I would like to do to start is to have brief introductions to the programs for you by each of the panelists, discussing what they are funding now, what segments in particular, what kinds of business plans they are receiving or proposals for project funding, and what their criteria are to determine which projects and companies they're funding at this point. So I'll turn the mic over to Mike.
Thank you. NYSERDA, I don't know how many of you are familiar with it, but it starts with NYS. So we're a state agency, the New York State Energy Research and Development Authority. We're a state agency concerned with energy research and development, and actually a lot more. NYSERDA has been around for about 30 years, started as an R&D funding agency, but swallowed in a reverse merger the State Energy Office in the 90s. And now the energy efficiency programs of the State Energy Office really constitute the bulk of what NYSERDA does. It's primarily a deployment agency with some research and development as part of that. To give you a sense of order of magnitude, this year our budget is bloated. It's about $600 million. Normally it's about $300 million, and of that, research and development is somewhere between 50 and $100 million. The research and development program at NYSERDA is a lot of it is very deployment oriented. It's aimed at validating technologies that you might think are already well developed and understood, but we really do need to collect a lot of data and make sure that the energy impacts are there, and that's what the bulk of NYSERDA's R&D funding goes to. But we do a lot of product development. Every year we have programs to fund product development. As it turns out, even though it's open to large companies and small companies and to universities and others, almost all our product development funding historically has gone to small companies, many of them in the very early stages. This product development comes in building technologies, it comes in heating and cooling technologies, power systems, renewable energy technologies, really quite across the board. We also administer some funding from the Department of Transportation to fund transportation technologies and fuel technologies. Now, NYSERDA has been doing this for about 30 years, as I've said, and we've funded a lot of technology, but only recently have we begun to look more closely at where we were funding the technology. As I said, it was primarily in small companies, many of them startups. And there's the perception that perhaps some of these technologies didn't progress to market as quickly or as surely as they could have, because NYSERDA hasn't been necessarily paying attention to the commercialization process or to the health of those small companies. And that's where the programs I manage come in. My program area is what we call our business development area. It is a part of our research and development funding program, and it involves support of incubators. We support 4 clean energy incubators in New York State, including the one at New York City Acre, which is sponsoring this program tonight. We are going to establish 2 more. There is a current solicitation out for us to establish another incubator on Long Island and another one somewhere in the Hudson Valley or the Capital District. So business incubation is now something that NYSERDA is involved in. We are also involved in business mentoring. We recently spun up an Entrepreneurs in Residence program. This is very new. We really haven't even built the roster of entrepreneurs in residence, but these individuals are there to help both NYSERDA grantees and companies flowing from our incubators and providing business mentoring assistance to them to make sure that they do get on the right track in terms of getting their business plans in shape as well as their technologies. That's in terms of the infrastructure we want to build, but I also manage a program called Clean Energy Business Growth and Development. Now, these incubators are funded by NYSERDA to help startups. Clean Energy Business Growth and Development is direct funding to companies. And it's not just to startups, but as it turns out, a lot of the companies we fund are relatively early stage again. The purpose behind Clean Energy Business Growth and Development is to support the building of these businesses, not necessarily their technologies. In fact, if you were to receive one of these awards, you can't spend the money on R&D, you can't spend it on product development, you can't spend it on manufacturing. The things you can spend it on are finding channels to market, going out and securing strategic partnering agreements, going out and raising money, and paying for the legal bills and the accountant's bills that you need to do those. That you need to pay in order to accomplish those things. That's our Clean Energy Business Growth and Development Program. This includes paying for management time. And that's actually one of the interesting aspects about this that I'd like to get into a little bit later. One of the things we are interested in doing is finding ways to support not just the technologist in an early stage company, which you can do with SBIRs and things like that, but also the management teams to keep those teams cohesive. I think I'll stop there.
Maria? Hi, everybody. So the New York City Investment Fund is a private fund, but we have a civic mission. And we are just focused on New York City, the 5 boroughs. And our mission is to create jobs in New York City. And we define that sort of in 2 areas. We look to do diversification of the economy, so growth sectors, and also inclusion, which picks up some of our projects in low-income neighborhoods and working with nonprofits. So our pool of capital, which was initially sort of raised by Henry Kravis of KKR, is about $110 million. We are an evergreen fund, and the investors that put the money up do not expect returns. So we have long-term patient capital. And we do everything from venture investments to loans to nonprofits. But we also take on larger economic development projects where, again, we're sort of trying to look for gaps in the economy and where a little bit of capital and time and effort on the part of our staff and board can help catalyze a bigger thing to happen. So we've been working very closely, for instance, with the city on trying to create a biotech industry. And in Cleantech, that's been a slightly newer initiative, I'd say the last three years or so. And we do have 3 investments, as Mary mentioned. They sort of reflect the range. We have a solar installer, and we also have a demand response aggregator and a wind developer. Now, they're not doing any projects in New York City, but from our perspective, a wind developer is basically a project finance company, and those are very sort of good, compatible New York City jobs. I sort of think of new energy companies as, wind or solar companies as, the parallel, I guess, is ExxonMobil. ExxonMobil does not drill for oil in Dallas, but that's where their headquarters is, and that's sort of very good jobs for New York City, are those kind of headquarters jobs. So we'll look very broadly on not just within Cleantech, but across all sectors. So we do digital media, IT, we've done restaurants in low-income neighborhoods. So in Cleantech, we're pretty broad. So I think if you should sort of if you've got something interesting to, come talk to us. If it is a more venture type technology company, we don't lead those deals. We only co-invest, and we're more of a strategic investor. We have a very interesting set of relationships in the corporate sector, many of whom could be potential customers or partners, and we sort of look to leverage our relationship as part of a syndicate to help the company. We will lead a deal that is either a nonprofit or more of an economic development deal. We have been sort of thinking about, how do you go after the lack of seed capital in the city for Cleantech? So that's probably an issue some of you early entrepreneurs are discovering. We don't have an answer yet, but we're looking at maybe a model of sort of matching capital to the venture community. From our perspective, the lack of an engineering school in New York, I think, has put us at a little bit of a disadvantage in terms of, hardcore technology that gets funded by the venture community. But in terms of sort of target areas that we think are interesting is obviously building systems, building regulation, control efficiency systems. As I said, I think there is a role for those companies that are project financed based, so in biomass. It may be that the technology deployment is elsewhere, but from a kind of a project basis, because a lot of those are, you know, financed on a project by project basis, the skill set in New York is actually very good for that. It's financing, legal, regulatory. And then, you know, if there would happen to be a great energy storage or battery company, that'd be great too. But again, I think we haven't seen very much of that, and I think that's really a factor of the fact we don't have a good engineering school, or I guess I would say top 10 engineering school. We've also spent a little bit of time thinking about a larger scale project that could have an impact on the city. If you look at sort of the assets that we have a lot of waste. So we have started to be approached by venture people who've got companies elsewhere who have said, we love the waste stream, because if you're in biomass processing, what you need is a large, consistent supply, and we potentially have that. So we've been, truly, we do have the most in the country, probably. So we've been looking at the possibility of putting together a Cleantech manufacturing park that would try to take advantage of that. So we're interested in talking to people that are involved in those kind of operations to get a sense of how good a fit that is with New York City. So, you know, for those of you in the industry, we have financing that can help fill gaps. And so as you're walking around New York City and you say, you know, somebody should do that or think about that or start that, we're always interested in ideas, because we can sometimes be that capital to get a bigger thing going, in addition to investing in individual companies. But we like sort of the combination of the projects.
Hi. I'll take I think a little bit of a 50,000-foot view of this from the federal perspective. The federal government is, you know, our involvement in commercialization of energy has been long-standing but sort of erratic. Our involvement in R&D has been pretty strong. It's been the commercialization part of that equation that has been very difficult for us. And we've gone through a few different models. Synfuels Corporation is one that sort of jumps out, and the Future Gen initiative that recently. And they've generally focused on sort of large projects where we see a need, some technology that's not being developed, and we try to step in. Frankly, they haven't worked that well, and so we've sort of reoriented ourselves. And starting about now 5 years ago, in the development of the 2005 energy bill, we started to try to figure out if there's a different place in the commercialization equation that the federal government can fill. And we created the loan guarantee program. That program was intended to help pull advanced technologies through the valley of death. And you know, and I just from our perspective, and I'll be interested if people disagree with this, but you know, our view of the energy space is that there's a couple of unique challenges. One is, of course, that there are externalities that are not currently priced in our energy system, and you know, that needs to be dealt with to fundamentally create a market. But for an entrepreneur, for somebody new into the energy space, you have large-scale incumbents that have fully amortized assets, very, very big generating assets that they're only paying fuel costs on. And so it's a very tough market to break into, and it is a very high capital market to break into, particularly the power generation into things. And so unlike, at least from our perspective, the IT field, where you had, I just heard this the other day, that Google took about $25 million of VC money to get to their IPO. And, I don't even know how giant their IPO was, but you know, obviously they're an outlier. But you know, but there were a lot of companies that could get through on equity capital alone. whether it was all VC or whether it was angel investment, they did get through on that, or very, very small debt. We don't see that as viable for a lot of the companies in this space. You've got to do debt financing. You're talking about orders of magnitude scale up from initial pilot scale production to final production. So we put in place a loan guarantee program. It had a sort of a rocky relationship with the administration, and it never really sort of took hold. So we began to try again in the 2007 energy bill. And in the 2007 energy bill, we created the Advanced Technology Vehicle Manufacturing Loan Program. That program, the idea was if you meet some marker, and what we set in place was a 25% improvement over the baseline emissions, fuel economy of vehicles in a given class, then we would give you a loan, and we could to build manufacturing facilities or to retool manufacturing facilities. So it was sort of the first time that we shifted from a technology-based approach to an outcome-based approach. If you could hit this mark, we could fund you. That eventually we were able to secure enough funding to support $25 billion worth of lending, and as Mary mentioned, Fisker I think got $500-something million loan. Ford somewhere on the order of $5 billion worth of lending for various facilities. Nissan, a couple billion, I believe, and Tesla was about $400 million. And there's more to come. We haven't used that up. And DOE administers that, and will continue to do it. Then now we're coming up to the next climate/energy bill, and our committee has passed out an energy package. And so what we've done is sort of taken that to the next step and create a new funding agency, the Clean Energy Deployment Administration. And the idea behind the Clean Energy Deployment Administration is to target this valley of death problem in a completely technology neutral approach. So it just looks at the greenhouse gas performance of a given technology. What does it do to solve basically our energy security and our climate security problems? Does it create some benefit to efficiency? Does it create some benefit to greenhouse gas emissions? Does it create some benefit to domestic supplies of energy that are environmentally sustainable? And what we did with that is we didn't list any technologies. We set out an advisory council that will develop its deployment goals, and that will help judge the validity of a given technological path. But fundamentally, it'll act like a bank. If you're going to come in with a business plan, if your business plan makes sense, and if you meet the metrics for the technology, then they should be able to either give you a loan guarantee, some other form of credit enhancement. Basically, they have the broadest form of authority that I think we've ever given an agency. And importantly, from our perspective, we pre-funded it. It has a $10 billion endowment. And that $10 billion endowment, I'm sure nobody is familiar with the arcane federal budgeting procedures, but the way we do budgeting in the federal government, it's on a net present value for all lending activities. So what we do is we assess the subsidy cost, which is essentially the risk of a given loan, and that amount has to be set aside into an insurance pool. So the $10 billion can support, depending on the risk of the investments, can support $100 billion, $200 billion, or more in lending activities. So it's a very good start. It's a big start. Obviously, we need to make sure that we do other things like RES and price on carbon to establish these marketplaces. But our idea is that you will have a facility that will work in concert with the private sector. And I should mention an important part of it is there's not only the direct support function, which is, lending, direct lending. We have an indirect support function where the federal government can stand behind another entity that does the frontline lending or the frontline investment activities. And we envision something like NYSERDA, right? NYSERDA might be able to pull together, say, energy efficiency retrofits for residences or distributed generation, and say we can package loans, that have a certain characteristic, and we can, and so we'd like to do $1 billion worth of these. SITA could lend them that $1 billion and just, and help set the underwriting standards for it, and then market market them as bonds or in some other way support their lending activities. That could be a very powerful mechanism for another part of the marketplace that is really kind of frozen, which is these small disaggregated loans that need to happen all over the country for buildings such as this. So it's passed the House. It's passed the House. It's in the House Climate Package. It's passed the Senate Energy Committee and is ready for packaging when we have a larger vehicle on the floor. I think that's probably a good overview for now, and we can happy to answer questions.
Great, thank you. Well, I'll go back over to the private sector. So SGF Venture is a growth stage venture fund with offices here in New York and North Carolina and San Francisco. And we investing in cleantech and tech services companies nationwide. And in energy, we're an investor in Growth Solar, which is a national solar integrator that has operations in New York and in other key markets around the country. We have an investment in Real Wind, which does building energy efficiency for large commercial REITs and utilities. Mary asked us to mention a couple of pending deals, the types of things we're interested in investing in now. We are a small fund. We invest $1 to $3 million, lead rounds up to 5, and so the capital intensity, which Mike mentioned, many of these opportunities is not a fit for a venture fund of our size. And we have seen many very large-scale venture financings of early-stage solar, biofuels, et cetera, which really require an IPO of the scale they 1, 2, 3, and for that price to hold for a venture return to be achieved. And so we think that we're glad that a lot of capital is being deployed in those segments, but it is a riskier proposition just for a venture capital return than we're able to take. And so what we're looking for is companies with big markets, but that are capital efficient, have proprietary technology, and there is a defensible advantage, and it's less of a commodity. So in solar, as an example, we didn't invest in thin film or concentrating or any of those breakthrough attempts at technology because you see that's a global market. You see solar panel prices have dropped almost in half over the last 18 to 24 months, highly competitive, and it's a race to more cost competitive solar power, which is fantastic. We said, what company will have a competitive advantage in the US? And our thesis was building a national branded high quality solar integrator installer, and that there was a roll-up strategy to be done there. And so that was why we invested in Growth Solar. So we look for those plays where it can make sense as there's going to be a competitive advantage in the US or in the markets where we invest. So there are a couple of deals where, knock on wood, it's always dangerous to talk about things that you haven't closed yet. We hope to be investing soon in a company that works in data center energy issues, and particularly as a company that came from customer demand. It was an energy-related company that began to work with large banking clients with data center issues, and both on the risk mitigation of their IT assets, but also the energy management. So it's a software company, fairly capital efficient. We're leading a deal with 2 other venture funds co-investing with us. It's about a $3 million round. Company's a couple million in revenue. It's on track to do much more than that next year. High margin, serving a really critical need, and seems to have a unique technology and software. The other one I'll just mention is in the smart grid area. We've seen a lot of activity of late, and we've been in a lot of federal investment as well, and we think there is a real need there, but again, it is a fairly capital-intensive place in general. So we looked at that, we said, what is needed for the smart grid to work? And one of the things you need is much better quality power line. power transmission, and you really need to get away from the run-to-fail system that the electric grid has now. So another company we have on a term sheet and are working to close shortly, I hope, is a company that does use RF signal to remotely sense failures in the electric grid and transformers before they happen, and allows the utility to Con Ed, instead of replacing every transformer, to replace the one out of the 100 that's going to fail in the next couple of years. So it serves an immediate ROI for the utilities, but it really enables broadband over power line or smart grid infrastructure to occur. So those are the kind of things that a fund like ours sees as opportunities. I think that we've been talking a good bit. We invest in a few companies a year. We see probably 200 or so opportunities a month. So it is an active market. We don't invest in real early stage investment opportunities. Mary asked, one of her questions was, when would we invest in a very early stage? And there is a company we're looking at now that is using European green building technology. It's been deployed in Europe very successfully, and it is no significant revenue in the US, but that is one theme that I think is interesting. There's been a lot of deployment in Europe, a little bit ahead of us in some of these areas. Is there a way to scale up some of those technologies rapidly as we get the kind of policy infrastructure for scaling in the US? And I think the last thing I'll mention is just that SJF, as Mary mentioned, has a broader positive impact mission. We have a separate firm called SJF Advisory Services. And some of you may remember we did the Cleantech CEO panels at Deutsche Bank here in Wall Street for a few years, trying to build a sense of real opportunity in the segment. Many of those companies, Recycle Bank, Zipcar, Grow Solar, and many others have gone on to great success. Our sense of the next stage was this whole area of matching talent with great entrepreneurial companies that are more technologists and don't sometimes have the management, business, marketing talent. So we're doing a Cleantech mentorship program launching this fall and starting next year with support from the Citigroup Foundation. And so I've got some flyers here if folks are interested. It's basically matching. We're getting a lot of IT, biotech entrepreneurs coming to us saying, I want to get involved in Cleantech. I've got the management skills, but I don't understand the energy markets. And then we've got on the other side, the energy tech entrepreneurs who understand their technology and the markets, the regulatory environment, don't have the management skills. So it's a sense of marrying those up to help scale the industry. So with that, we'll go to some, back to you.
Questions. First, a little bit more about the audience. How many people are in here who might be candidates for the Dave Kirkpatrick's mentorship program, where they're either from regulatory backgrounds or management who might be interested in getting into clean tech? Great. Super. Yeah. Make sure you see him. Secondly, we were talking a little bit about New York and the profile of New York in terms of technology, innovation in the entrepreneurship area, as well as maybe more project finance type of opportunities. For the people who identify themselves as entrepreneurs, can you just put up your hands if you've got a technology-based entrepreneurial activity as opposed to a more project finance or service-oriented? Okay, that's helpful. Thanks.
Well, can we see the hands of the other sides of service or project?
Yeah, can we see the hands of people who are in service or project finance entrepreneurs? Okay. This is great. Okay, so we have some questions about we have an unusual opportunity here because we've got people from really very different kind of funding areas. And one of the questions that entrepreneurs have, I mean, and I think I'd like to ask it on kind of a couple levels. One is for the Maria, you talked about the seed problem where people might need 25, 50 grand, 100 grand to get going. One of this is an incredible opportunity to give some feedback to people about what to do. The credit markets are very tough on credit cards for people who have been self-financing or who had a model like that. A lot of people were had their business and personal credit cards, which had provided that up to 100K number, wiped out with the financial crisis. First I'm interested in your ideas about where you can go. Maria, you mentioned a couple of ideas there. And then secondly, for businesses either on the service side, which are looking for numbers more like 250, where you see those kind of opportunities and how they fit into what you're, either what you're doing or where you're seeing opportunity, other entities investing and supporting. And there that would be of interest. And then what I'm interested in understanding is, to what extent are you, when you are making investments, irrespective of the numbers on the seed side, thinking about each other? In other words, if Mike, you're providing a technology deployment grant, are you thinking about the potential of a SJF Ventures to come on in afterward, or is that not part of your consideration? And if it is, how can entrepreneurs come to you to signal that kind of activity or interest or planning?
So the whole seed investing area is very interesting in New York City. If you think about where the money is, it tends to be out of the financial sector. And that has been a source of, mostly you happen to know somebody who's an investment banker, got a big bonus and you got some money from them. It hasn't traditionally been from entrepreneurs funding entrepreneurs. That has started to change in the digital media IT sector, because we actually have a pretty vibrant now entrepreneurial sector. So we've had people who've been entrepreneurs, who had made money, been successful, who are now doing what entrepreneurs do, which is funding the next kind of, seeding the next round of companies. But in the sectors where we don't have as much of a developed area, like biotech and clean tech, you still have that sort of old problem. You don't have a class of experienced business people in the sector that you're working to go tap for money, who, so you're sort of back to looking for the hedge fund and financial services people. I think clean tech, they're sort of, it's almost bifurcated, right? So for the IT world, you need a little bit less money. I mean, that's a little bit more like digital media, where you can work at Starbucks and, and in that world, even the digital media space, you're back to sweat equity. So a certain amount of, just plowing through it to get to a certain point, you've got a beta. And the IT side is kind of where the market is right now. 18 months ago, you could get funded for an idea. Now it's much tougher. So for those of you in the IT space, you got to get to a certain point before anybody's going to fund you. That's just sort of the reality right now. We have, along with Polytechnic University and the state, with participation from the city and ITech, have set up a seed funding initiative to address this issue of not enough seed capital in New York City relative to what we thought good ideas. It has focused on digital media and IT, but for those of you with IT clean tech, you should send us something. That's nycc.com, because we're starting to, again, as I mentioned, sort of think about how do you, if it's enough of a sort of IT with a little bit of clean tech crossover, it might fit our criteria. For those bigger projects that are not IT based, I'll let Mike handle that. I'm gonna toss that back to the public sector, because that funding is really not, in New York City, there's not from the private sector side. There are a couple of funds that do early stage, but it's a handful, unfortunately. So tossing it back to Mike.
I'm not sure how well I'm going to field that, really. I think you're right, that there's a lot of technology-based companies out there that simply need capital. And a lot of that capital is going to go into development work, product development, process development, and so forth. And I'm not even getting into the projects, the generation projects, obviously. I'm really just sticking with product-based companies. And yeah, to a large degree, NYSERDA's, that's what our product development grant opportunities are there for. I mean, these can go up to $1 million apiece in some of these areas, especially in things like energy storage or power systems. We have demonstration projects that can be funded at up to $1.5 million apiece, and that's all good. That's all good capital. But again, it tends to be aimed at solving the technology side of things. On the other side, I was asked whether we put money into these projects with an eye toward future financing from venture capitalists, and there are two answers to that. About 5 years ago and earlier, there was the assumption that there would be future financing for these projects, and it hasn't always turned out that way. So we're being a little more proactive now. I really applaud SJF's mentorship program, because I think that's exactly what a lot of the companies that have received NYSERDA funding need, and that's why we're putting together an entrepreneur in residence program ourselves, because we see the need to coach a lot of these companies to become investment ready. We're in very early stages of that. The incubators that we support are part of that effort, and we'll see how it goes. But I think most of us are on the same page in this. We're all seeing the desire to have more startup management talent, more serial entrepreneur class talent come into the clean tech sector. And I think all of us are looking for ways to crack that.
I would just mention, in terms of co-investment, we certainly generally look to collaborate with other funds, which are co-investing in New York if we could, with NYSERDA, if we could find the right opportunity together. And the deal that I mentioned is us leading with 2 other venture funds participating. We often co-invest, usually after angel rounds, and sometimes it's a little sticky in terms of just the terms, but generally it can work and has worked successfully. In terms of governmental programs, we've co-invested afterwards with the Ben Franklin program in Pennsylvania. One of the deals I just mentioned, we're looking at an EDA-related, non-dilutive sort of financing to go on in addition to our capital. So definitely it's more collaborative in how to get the resources to help the company grow. I think one of the federal programs that we've seen, my only sort of caution or concern is that they have been very big projects, so far. The stimulus dollars, many of them gone to very large wind farms by Spanish developers, actually, and some of these others. And so I think one of the challenges for the federal initiatives, and maybe even state, is how do you get that to the broader, how do you use intermediaries to get that to the broader multitude of high growth companies across the country? And because I think that if transactionally, I understand why you want to do a $500 million loan to Tesla's versus $501 million loans, but there are intermediary methods for getting that capital more efficiently to a broader range of entrepreneurial ventures. So.
I'll just add one thing. Now, there's a wonderful New York State tax credit. The trick is you have to have spent the money in order to get the money, but if you've been able to raise a little bit of money, this can help you keep going. It's called the QETC, the Qualified Emerging Tax Credit. It's targeted at technology companies, and it's a refundable tax credit. That means you get cash back. So if you are not making money, it's all part of your tax returns that you put in, but again, it's to reimburse you for money that you've spent on R&D and I think some training. But for those of you that are maybe raise a little bit of angel money, spend on R&D, and are looking for a little bit longer runway, this is a place to potentially look. And you can get up to $250,000 for a maximum of 4 years. So it can be serious money for an early stage company.
And the companies, the type of companies that are gaining that?
Technology, broadly defined. So biotech, IT. I would imagine any kind of clean tech company would qualify.
Go ahead.
David brought up a really good point, and I wanted to expand on it a little bit, in that we've had this same concern about, almost by its nature, the loan guarantee program has tended to target very large projects. Part of that was the nature of the original loan guarantee program, where the applicant, frankly, paid all the subsidy costs. So who can come up with the subsidy costs that's going to be a large investor. But it was mostly aimed at utilities, so that wasn't terribly shocking. The subsequent iterations, beginning with the stimulus fund, the stimulus funding, we've tried to push down lower into the lending scale. There is a resource, frankly, a resource issue in having the Department of Energy issue these loans. So far, they've issued one out of the loan guarantee program. They will start issuing a lot more. They've got 15 teams of people that are running through these applications. They did manage to get a bunch of ARPA-E grants out, and so they are staffed up. But at the end of the day, it's not even a big bank from a staff perspective. It's a smallish bank. So what DOE has started to do, and what we've incorporated into the SITA legislation, is this idea of indirect lending, where you stand one step removed from the origination of the lending. DOE has issued a solicitation for what they call the FIP program, the financial, I don't remember what it all stands for. The short of it is, it's banks would apply, they would originate the loans, they would do the due diligence, and they would have some skin in the game. DOE would stand behind them, issue the actual loan guarantee, and so they hope unclog that pipeline. And then SITA takes that again to the next step, where they have a specific mission to seek to play an aggregate role and stand even another step behind the state agencies, municipalities, incubator funds. Really, you can sort of imagine a dozen different ways this could take place, but where essentially they're providing, if you will agree to follow their metrics, and their metrics again are just greenhouse gas efficiency and energy security. If you will follow those metrics and sort of provide the scoring to them, then they can provide you with the cheap capital to push it out to the smaller entities. We're very cognizant of the fact that this valley of death problem is the most acute when you get to the smaller entities, and unfortunately, in some regard, that's where the innovation is likely to come from. So we really are trying to figure out ways to pull the smaller entities into that process, and we think we've struck on a way to do it, but I encourage people actually to do some thinking about it and think about how you might interact with intermediaries and help us craft that better.
I have some follow-up questions. There's this conversation that Mike, you and Dave have had about the companies that are investment ready, and focus both at NYSERDA and at SJF on doing training. Can you talk about, as investors, what your concerns are about the teams that you're seeing, and where you see the need for the development of teams from the applicants and business plans that you're seeing? That's a first question. The second is, there's a mention, Dave, you made about the angel terms, and that there is some crafting that you're needing to do. And I think that's an important thing to get into, which is, what are angel terms that are difficult that you see that need to be crafted around? And Maria, maybe you have some comments about that as well. But this is something that a lot of entrepreneurs are faced with. They have an opportunity to get some money from some friends and family, and what should they be looking to avoid there? And then thirdly, Mike, you talked about some of the metrics for the funding in terms of greenhouse gas and efficiency. That would be interesting to share what some of those actually are, to see if the targets for some of the technology are even in the right realm, and they're aiming high enough or in that area. So.
Julius.
Yeah.
So on teams, I think that the challenge that we're seeking to address with the mentorship is, we often see very focused on the technology sometimes on the market, but just needing the finance, marketing, just the broader management skills. So I think the risks that we've seen across Cleantech, including in other segments like recycling and others, is a little bit too much focus on how wonderful my technology is, and not nearly enough on market and how it's solving a customer problem and how to get it to market and distribution and competitive advantage. So, but that all can be addressed by just bringing on advisors. They don't actually have to become full-time. Well, there's certainly lots of opportunities for shared services for good quality management as well. And then on terms and angel rounds, I think I'd just say get legal counsel that has really done angel to venture deals significantly and have them advise you. Generally, the issues we encounter are real early stage ventures that raise capital at, I must say, fairly high valuations before there's any real proof or revenue or certainly way far from any profitability. And then they run out of those angel sources. They have to go to venture, and there's sort of this reset issue of I raised it 10 million, but venture's only giving me a 5 million valuation and disappointing all the angels in there. So generally we prefer to have sort of angel terms that are maybe a convertible that converts with a discount to the venture round. So they get you don't set the price quite yet till you get a little bit more traction. So those are a couple of thoughts. Make sure you don't have blocking rights too. We've encountered multiple tranches of angel rounds with multiple blocking rights, and just becomes a mess. So just having good counsel will help you with that.
Just because your brother-in-law will value your company at $15 million does not mean it's worth $15 million. And as Dave said, that's going to cause a lot of trouble with the VCs and a Thanksgiving dinner. So be realistic, even if it means a small valuation. And just remember, zero of a big number is zero, right? Keep that in mind. So in our seed fund, we don't set a valuation, just as sort of a data point. We do it's a convertible debt, and it's convertible to the next round at a percentage. So on some of we're sort of setting a valuation, but it's sort of anybody's guess. At an early stage company, there are ranges depending on the sector. But I think kind of some, to Dave's point, some kind of a convertible at discount, into the next round is really your best bet to go. So you love your brother-in-law, but don't let him set a high valuation.
Where do you go to get a valuation if you're very early? Do you have any advice about that?
$1 million. If you've got nothing, $1 million. You get a little prototype. It's not a big number. So that's why I do convertibles.
Yeah, I think, and I mean, we tend to invest. We hope when there's some revenue and some metrics where you can look at comparables in the public or private markets. But with real early stage, if you really got to set a valuation, you've got to close around as pre-revenue. A lot of it is making sure the founders and management are incentivized enough. And if this is a Series A, you got a little room for a B and C if you think you're going to need it, and you kind of run the numbers out so that not everyone's thrilled, but the venture firm, if they can make 5 to 10 to 15 times the money, the founders are going to do extremely well, even if the pre is 4 instead of 8 pre-money valuation. So just thinking through some of that if you need to do that at that stage.
Thank you. That's a big issue for people who are getting going. Mike, do you have some thoughts to share about the metrics that the SITA program's targeting?
Yeah, the way we do it is actually at a higher level than I think one might anticipate. I guess one way to think about it. Think about the way a large agency gets their guidance, which is you do very far-looking analysis and say, we think DOE has these things. They publish 20-year plans. They publish 30-year plans. And so they'll say that 20 years out, we think X percent of the grid could be serviced by wind. Y percent can be serviced by distributed solar. That's the kind of goal setting that we actually want them to set for SITA.
And then you back up from that and you say, well, you know, if we're looking 20 years out and we're not deploying anything in the PV space right now, are we ever going to hit that goal? And if you're not, then you're gonna sort of put your thumb on the scale a little bit more towards that space. You say, well, you know, that basically identifies your holes, your problems. The metrics that SITA would look at on a project-by-project basis would be not, you know, you have to hit X number. It would be to compare project A versus project B versus project C, because that's the way these things always work. You get, you know, the current DOE programs have hundreds and hundreds of applications. So it's a way to sort of impose a score on a given project or company and say, you know, this you hit, you know, you score, say, to like a 7 out of 10 on energy security, and you score a 5 out of 10 on GHG emissions, and compare that total score versus another funding opportunity. And it's just a way to help rank order where you're going to put scarce resources. But you know, the sort of the larger issues of, you know, what makes something bankable, the market does that, and you know, and the market, of course, shaped by hopefully us being able to finally price in some of the externalities that are not currently priced. But that is really assumed, and it has to be over the long term, because we can't do it on a project-by-project basis.
I want to ask some questions now about companies that are a little further down the road. For companies that have a technology and it's being validated, there's an opportunity here with the government funding for project finance. And one of the questions is, how do you, as a startup company or a young company, tap into those opportunities? And is there a way to coordinate some of the efforts, for example, doing validation testing from NYSERDA into rollout within communities where the programs might be funded by, you know, a DOE type of project? And to what extent is that path from early technology development into commercialization being coordinated or thought about in terms of follow-on business development opportunities?
Well, it's being thought about. I guess what I'd say is, you know, to be fair to DOE, they haven't had a mechanism really to follow through on anything. I mean, I think they do. The scientists over there do reach out in the communities. They have a pretty good idea of sort of what the technologies are out there and what people are trying to put together. But they haven't had really any program that they can point to and say, this is how we're going to pull this into the commercial space. They have entrepreneurs in residence at some of the labs, and so that helps with lab technology, and you know, those are somewhat linked up. They have grant programs and, you know, R&D grants that are going to many of the academic research institutions around the country, and so they have a pretty good idea of, you know, the enterprises that are getting started at Stanford and Berkeley and MIT, and you know, and so they've built some relationships with some of the VC funds that have grown up around those, but you know, to date, they're really, it sort of falls off the cliff at that point. I mean, you know, the ARPA-E just did its first round, so that's sort of the next stage of potential investing. That's more of a sort of an equity play, and then then SITA would we think fill in that next round of gap, where you can you could set up a program where you could say, you know, if your company looks like this, you know, the door's open. This is you know, you can steer people finally towards something. Right now, you know, there's sort of this vague notion that, well, we'd like to get you into a loan guarantee program, but there hasn't been the capacity.
How would you see, you had mentioned the possible scenario where the SITA money could be available for a distribution, or I'm not going to say this right, with something like a NYSERDA or a NYSIF. How do you see that working?
So one model that is run up pretty recently is the sort of the Berkeley First model. And so in Berkeley, they created a mechanism whereby they could issue property tax-backed bonds, and it was a special bond issue. And so if you wanted to put solar on your roof, you would apply for in this program, and there would be a bond that would essentially guarantee the payback. And so it made your $10,000, $15,000 loan bankable, because a bank could look at that and say, well, even if you don't get the realized savings that we would anticipate, the property tax assessment is going to eventually pay us back. Now that's Berkeley. Berkeley was able to do that. Boulder is the other place that has one of these. There's a kind of a commonality there, in that not a lot of jurisdictions are going to be able to do something like that. What could happen is a state, or a state-based entity, like say NYSERDA, could create that kind of a program. It doesn't have to necessarily be property backed, bond backed. It could be it could be bankable out of some statewide issuance, or some combination of guarantees issued at the state and federal level, some tax revenue, you name it. So you could tap a bunch of different sources. And one of the things that actually I found fascinating was, despite this interesting thing that Berkeley did, it took them forever to find a bank. They actually couldn't find a bank right away. What we would envision is that SITA would be ready to step into that role immediately, and bank that product. And in fact, survey the entities out there and come up with some ways to do it. I mean, there's on-bill financing. There's another great way to guarantee a return. So they could set this up with a utility. They could go to the utility and say, well, we'll support if you'll offer this on-bill financing method to guarantee the return. It would be very low interest rates, and we could even, SITA could even, push that down with using their reserves. So, what we're trying to do is figure out a way that an entity could sort of exert some pull on the creativity of various entities out there, whether it be municipalities, state-based, or utilities, to come up with bankable products.
So this is a really interesting area, and we're sitting here in the capital of finance, and basically a lot of these problems have to do with financial structuring. So hopefully some smart people on Wall Street, or those of you who've lost your jobs as mortgage brokers, will move into clean financing. But you should add the town of Babylon to your list, because the town of Babylon did the exact same thing. They just repurposed their solid waste taxing authority, and they said carbon is a solid waste, therefore we can do this program. So give New York a plug. But anyway, the problem in New York is if you can't find a clever way to work around, New York State has to give the local municipality the bonding authority to do that. So absent that, NYSERDA can't really do anything. And I think that what's interesting about that structure is it aligns the incentives, and it puts the repayment obligation at the same level of a tax as opposed to a second mortgage at the bottom of the stack. So hopefully, we haven't seen any companies, but it would be nice. I think there's a role out there for kind of financial structuring companies to go after this whole energy efficiency area. We've started to see a couple of funds looking at this. But as anybody who sort of knows New York City real estate in particular, our incentives are all completely misaligned, right? So the person who builds the building is different from who owns it, is different who rents it. So the entity that can figure out how do you structure around it and align the incentives, it sounds like there's a potentially very interesting marriage with the capital sources to sort of back that up. So I'd encourage you all to sort of think about that. But New York State needs to sort of play ball as well.
One comment, it relates back to the valuation, is that we we do often see sort of step function business plans that say we've got to have $20 million to prove this concept, this breakthrough concept, and it's very difficult to fund something like that. And so we do believe, in the couple examples I mentioned, that especially in efficiency in many areas of our economy, we're still extremely inefficient: industrial, building, transportation, and that there are kind of step-by-step approaches that are smaller steps, which allow you to raise capital of $1 million or $2 million, really get some sales, and then the next step is versus that big number. And that to me, those kinds of business models are much more attractive and interesting than that huge sort of do it or nothing kind of approach.
I want to ask the question about job creation. That is an issue with a number of the people on the panel here, and how important that is, both in business plans and in project proposals, in terms of the evaluation or qualification for some of the funding or program opportunities.
So that's a big priority for us. But I would say in New York City, there has been a lot more yakking about green jobs than there has actually been green job creation. So I was at a meeting, I don't know, a couple months ago, and there were about 100 people in the room, and there was labor, it was government, nonprofits. That group of people represented probably more people than there are actually green collar jobs in the city. So so it's very encouraging to see all of you entrepreneurs in the room, because we need more of it. So from our perspective, job creation, a big priority. Unfortunately, in New York City, it's been a trickle.
Yeah, I think NYSERDA has a somewhat of a job creation interest and mandate. No question that economic development is part of what we do. Whether we measure that directly in jobs created, as some other economic development entities might, it's a little bit different for us. Yes, particularly in our manufacturing incentive programs, we look at anticipated jobs created. In our clean energy business growth and development, we want to know what the job creation expectation is. But what I think we really want to do is help create this ecosystem by which jobs get created. And if we can't quite count them, well, that's all right, as long as the ecosystem is healthy. To the point about green jobs, this is actually something that I think we've all run into this definitional issue about green jobs. There are those who have simply reclassified a lot of jobs and have called them green jobs. I think that's there's a lot of that, and then there are the jobs that I think we're all interested in creating, which emerge from this kind of innovation economy. New high skill, wealth creating jobs in entrepreneurial companies. But there are also a lot of incentives out there, or programs out there. For example, the $112 million, I've forgotten what the actual name of it was, but it's essentially a green jobs program funded by Reggie, which pays for energy efficiency projects. And of course, what does that do? Well, it makes a lot of homes and businesses more energy efficient, but it creates jobs for all the people who are going to actually implement those programs, and those are green jobs. And I think we're calling green jobs, or we're using the term green jobs to refer to a bunch of different kind of economic growth concepts here.
Just one thing on green jobs. Particularly in Congress, everybody wants to assign some number to any amount of money, any check we write. It's going to create X jobs, and it's a very frustrating metric to deal with, because, well, it's hard to measure, but it's that isn't actually the point in the green jobs, in the clean tech space, and we've sort of tried to
put this message out there. I wouldn't say, oh, don't try to calculate this number, but keep in mind, I mean, the objective here is not strictly green jobs creation today. It's industry creation. It's, you know, the fact of the matter is, the last few great industries that have been created worldwide, global industries, the United States has been the leader in them. IT, you know, pharmaceuticals, you know, basically, you know, you can kind of go through everything that's recently happened and we led. We're not leading in clean tech, and you can go you know, sector by sector, piece by piece. You know, the technologies are being developed here, the deployments are not, and so that is, I think, the biggest danger. I mean, there was the story just today about this big wind farm that's going in Texas with Chinese parts. Now, you know, so a lot of people in Congress are going to wring their hands and be very, very frustrated about what do we do about that? You know, should we let this be built by, you know, from a Chinese manufacturer? Well, the fact of the matter is, we don't have a big enough market in the United States to support domestic manufacturing. We have not yet had that, and so, you know, that's going to happen. We're gonna have less green jobs these initial deployments than we should, because we have not supported it to the level that it needs to support domestic manufacturing. You look at a wind turbine, I guarantee it is the cheapest way to do it. I don't care what the labor costs are. The cheapest way to do it is to build it close to the site. Those things are huge. You know, there's a lot of material costs, a lot of shipping costs. You know, you would not, you know, with a blank sheet of paper, put the manufacturing in China to bring something over to Texas. But it's, you know, that's where the markets are. You know, you would not also have the source of most of the solar panels in this country, or, you know, you would not be shipping them to Germany. You know, it has some of the lowest solar incidence in the world. You would, you know, but we're not manufacturing that stuff here. You know, we're manufacturing stuff in Germany and importing it here. That's crazy. But, you know, you have to kind of keep your eye on the ball a little bit down the way here.
Dave, do you want to talk about?
Well, I want to get maybe some questions from the audience too, so I think I agree with all of the points. I guess the one thing I would add, I'm from North Carolina, you may be able to tell from my accent, and when we look at North Carolina's energy economy, we spend all of our money in imported energy, about $20 billion a year. None of it is domestic. We don't have any, you know, we don't have natural gas or coal. And so the way we think about it is for the additional efficiency, for the additional solar, wind, hydro that we generate in North Carolina, that's all purely additive. So it is really replacing labor and innovation domestically with imported energy, and so there is unlike some of the job creation, which is really shifting, there is a net gain here if we can kind of create this. I do think that it is a global economy, and solar, yes, I think just like microelectronics, we are going to have a global supply chain, and there's some parts of it that are not going to be made in the U.S., and it is going to drive down costs for solar to be integrated in the U.S. And I think to some extent we need to support appropriate innovation in the U.S., but also support global innovation as well.
I think we ought to, as Dave, you suggest, open it up to some questions from the audience. So, let's see. Some hands. A couple of people are interested. Okay, can we take the call?
Sure. One thing about the IT, it's been mentioned that's an area that's sort of new, it sounds like. I've heard of IT applications in green for building management and monitoring. Are you all seeing other types of IT applications? That's my background, and it seems like an opportunity for some sort of new innovation to really sort of create more efficiencies.
At some point when there's a carbon trading scheme, I mean, I guess I think of IT as could be financial services IT, so there's probably a whole range of products, platforms, et cetera, to deal with that. We started to see a couple of companies have been going after that. The problem is no one knows what it is, so what are you going after? But my guess is, you know, aside from the building management systems, that's an area actually that plays New York City's strengths, but at some point, you know, you're going to need those tools as well.
You know, Vornado just announced 2 weeks ago that they're now making consumption data available to their tenants. so their tenants can see their waste, their water, and their electric energy, and that was all done through smart building systems.
Cool, thanks.
Just real quick, the two things just leapt to mind. One is, particularly if we have a carbon scheme, but you know, a renewable electricity standard can do the same thing. You're going to have these issues where you're going to have very small scale generation that are seeking ways to monetize their generation and you know get credits, whether it's carbon, whether it's you know renewable electricity. So at that level, I think there's probably a lot of opportunities. The other thing is a lot of people think of smart grid as the smart meter at your house, but there's actually a lot upstream that is that has essentially no IT investment to this point. You know, we have a fairly creaky, outdated grid that I think there is a lot of interest in federal investment in dealing with reliability and just sort of routing power from point A to point B. So that's, I think, a really possible.
Another question?
An overview. You mentioned the long-term perspective of the DOE with the grid for electricity, and I guess some of that reflects upon gas and oil usage in home and heating. What's the long-term view of the petroleum industry, and what other energy sources are going to be seen as supplying some of that? Does the DOE make any of those long-term projections?
Yeah, you can look at the EIA Energy Outlook. They publish it every year, and they do those projections. The Vehicle Technologies Office does projections on what we can do sort of from the efficiency standpoint. There's a lot of data created, but I mean, but I think what I've sort of heard most recently is sort of the long-term views. Is there's sort of two schools of thought of where we're going to go on reducing that. One is substituting biomass for a lot of that chain, and that may be everything from commodity, this is made out of corn, and to fuels, higher order alcohols, and then or electrification of the transportation sector, or diverting into some of the more efficient modes, whether it be electric freight or just long haul freight. That's sort of it's sort of efficiency first, and then then sort of replacing over the longer term.
Other questions? Right here.
I started a company that does home energy efficiency in small business. From our standpoint, it's really not about innovation. It's figuring out how to get it to market. The technologies have been figured out in the 70s and 80s, and we know how to make buildings solid. But that means that it ends up being sort of much more regional, smaller business, contractor type businesses, as opposed to creating a new technology that's going to splash and change the way solar is deployed. What are the kind of financing options? Because when I go in and talk to the bank, they say, well, you got to be in your business for 2 years. Why don't you talk to SBA?
What's the scale of the funds you're looking for?
We're looking at like 200, 250. But small stuff, and really it's just to scale up and bring it to a point that's really work.
Right. Any ideas here?
I think it is tough for a services business that is smaller and is in terms of institutional investment sort of penciling out how it can be bigger. I mean, Grow Solar is a services business, but they had aspirations to be a national company and to provide us a thesis for a venture return. So I think it is challenged. I agree. The technologies are there. We've got to deploy them. And that was kind of going back to my point about these monstrous loans and how do we provide some incentives for the banking system, the lending system, to support companies like yours in a more efficient manner where it's sort of broken today. So I don't see it unless there's angel investment that's longer term that ties to your vision and or sort of fixing a sort of broken lending system at this point. So.
NYSERDA gets this question all the time, and the answer, unfortunately, is NYSERDA really doesn't have a program for that. We kind of view the standard incentives that we offer for things like residential energy efficiency or commercial energy efficiency or for solar installations or for small wind installations as being our contribution to that, to the viability of companies that are engaged in those markets.
Let me ask you a question. How many jobs do you have, and how many are you projecting to grow to?
Currently we're about 10 people, but it's really just a matter of having the capital to scale. And what I find is that as each step I grow, we're able to to make it kind of get to the next level of profitability very quickly. But you still need that money to buy equipment, to bring people on, to train them. So it's could be very large, but it's still very regional, because you're going, you're convincing each individual homeowner that this is something that makes sense. So it's a very in the trenches kind of business.
Okay, thanks. Another question, right here.
Mike, David mentioned A123 Systems, which is a battery company, which is NYC spin-out, which went public recently, which was a very reception. My question is regarding your investments that you spoke about, Tesla, GM. Those are either energy production companies or carbon emission reduction companies. And you mentioned that your investments are technology neutral and output focused. So can you speak a little about maybe your investments in battery or storage companies, which to my mind really aren't, where the technology really matters and the output is maybe harder to assess? Because I would think that storage and batteries are as important to evolve and create as are production companies.
Well, A123 got a $400 million grant, so we support that. But they're also in the same program that Tesla got their loan out. It's for component manufacturers as well. But again, that was a slice of the market. It was targeted at the transportation sector. It's fairly technology neutral, but it's still targeted to that sector. So A123, since they intend to produce batteries for that application, then they can apply, and I think they're somewhere along in the process. I think their long-term vision is to deploy over $1 billion worth of capital to build out their facilities here in the U.S. So the grant got them part of the way, and I think they're looking to the loan program to do the rest. There are several battery manufacturers that are in the loan guarantee program queue right now. We have a specific recognition of storage in the SITA package as sort of one of the goal-setting activities. So we would expect that again that SITA would lend to that. There's a very strong recognition in batteries. It's just the mechanisms haven't been in place, but they're coming.
Other questions right here?
Yeah, my question has to do with the government guarantee of bank loans. I need a little bit more detail on that. I mean, basically, we're 2 years into a project that basically lowers emissions more than 25% and is increasing fuel efficiency at least 25%. So it probably fits into that category. But I'm not sure of the steps or the procedures. I mean, tomorrow morning I'm going to walk to my bank officer, Enoch, and say, hey, the $100,000 that Chase wants back, I got a better idea. This nice guy I talked to said that they're going to guarantee you another $900,000 loan. So just call him, it'll be okay. So I really want some detail about the steps, the timelines, or even better yet, is there somebody kind of hired to walk us through by the hand on the procedures?
It sort of depends on what you're talking about. So there's two different programs. There's a loan guarantee program.
And that's my question, yeah.
Okay, that is tied to renewable energy, grid efficiency, and sort of advanced technology.
Mm-hmm.
The vehicles loans I was talking about are direct loans, and they're tied directly to vehicles and a certain fuel efficiency bump. I'll be quite frank with the vehicles loans, they're going to OEMs or or fairly large entities. I think the smallest one they've issued, they just issued, I think it was $55 million to a component manufacturer. So for smaller entities that are sort of technology providers to a larger system, you've got to partner up. You've got to have your sort of your OEM, your actual producer go in and look for the money. You know, it just from a pure economy of scale perspective, I think it's very hard for DOE to issue a couple $100,000 loan, a $900,000 loan. I mean, that looks like a grant to them. That's not the volume that they can do months of due diligence and and devote a lot of man hours to doing. I just don't think the equation works. The FIP program, which by the way I remembered, it's Financial Institution Partnership Program, so FIPP, is to provide underwriting standards to for lenders. And so the applicants they're looking for right now are people who want to be the lenders, the frontline lenders. At the moment, they just closed the application process, or they just issued the application process weeks ago. So I mean, this is really in its nascent stages. So, I think the question to ask your bank or whoever is, are you applying to this program? Are you going to go out there and go get in the FIP program so that you can get underwriting for that lending?
Maybe we need
Thank
an
you.
email we can distribute to everybody.
Mine?
No,
Is there a website?
to forward to the banks.
Yeah, I mean, the two important websites, I mean, there's energy.gov, which is the Department of Energy's website, and recovery.gov. Recovery.gov has got all the stimulus programs in it. So you can take a look at that. You'll see, right on the Energy Department webpage, the FIP program, the loan guarantee program, all that stuff like that.
Okay. We are kind of running out of time here. I don't know if there are any last comments that the panel wants to make. I want to thank everyone. I encourage you to stay. We're going to take some of the chairs out of the back so there's a little bit more room to move around and meet people. I encourage you all to come up and meet the panelists. They've expressed some interest in meeting you, and it's one of the things we're happiest to do here at NYC, introduce people. Thank you very, very much. I appreciate the opportunity.